Four biggest risks in multifamily investing and how to offset them. Hey everyone, welcome to another video. Today we're going to talk about some of the risks of actually buying and investing in multifamily properties. Now, a lot of people invest in multifamily because of its safety net. It's generally seen as a much safer investment than other commercial assets such as office, industrial, and retail. But multifamily has its risks just the same. A lot of it might just be hiding under the surface. So we're going to dive into the four biggest ones and also how you can be mindful of them and potentially offset some of these risks. No investment is going to have zero risk, but limiting the downside is a huge step in being a successful multifamily investor. So let's get into it. The first one we have is unexpected capex. Now, when you go through due diligence, you're going to be hopefully doing an inspection of all of the systems in the building, the plumbing, the HVAC, the electrical systems. Something comes up, and it, especially in the near term, and it's a large capex item, it's really going to turn your numbers in a bad way. So imagine you buy a $10 million building and you suddenly find out you have a $1.5 million HVAC replacement. You do it, and now your return numbers are going to be significantly affected by that. So how do you offset this risk of capex? You're always going to need capex on the building if you hold it for any substantial amount of time, 3 years plus. So you can't offset the need for large capex items, but you can know when they come up. So when you're doing your due diligence, very important to have a professional come and look at all the items and run down the checklist and look at not just what condition they're in, but how much life they have left. And if you can put that in your underwriting, then you can expect when that replacement will need to come up. The second part is just putting aside replacement reserves. Now, this is where unexpected capex in the near term can really hurt because you haven't had a chance to set aside some additional capital to perform that capex. But after you've held it for a few years, if you have been setting some aside, then it'll be able to absorb that cost rather than be surprised when a large capex item comes up. So a lot of people use the number $250 per unit per year as setting aside for capex items, and that's generally a pretty good number, but definitely can vary depending on the age and size of the building and even the location. So unexpected capex, huge one, very obvious one as well. Even in a condo building, unexpected capex can really wreak havoc on the condo owners themselves, not just multifamily apartments. Delinquent tenants, number two. So in the past few years, there's been a real shortage of rental properties, rental units, and that's caused prices to skyrocket. Occupancies have been very high, rents have been high. So we don't talk about delinquent tenants too much, but we are seeing a bit of correction where we are now in 2025, and we're going to start seeing a lot more delinquencies, especially if the economy starts teetering a little bit. So you're going to have not just in Class C and B, but even in Class A, if you start to see job losses across the board, you're going to see a spike in these delinquent tenants. And if you've been underwriting to 95% occupancy or higher, then this is severely going to be affected. The other part of it is just tenant screening. So you have the macro side where if the economy turns, you're going to see some delinquent tenants. That's just going to be across the board. But if the management and leasing isn't up to par, the screening of tenants isn't good. There isn't enough diligence being done in collecting rents and making sure that delinquent tenants are caught up. then this is severely going to hurt the bottom line. You can do everything else right from a management perspective, but if you're not pulling in that revenue, it's going to be a huge killer to the investment, the cash flow, and also what it's going to be worth when it's time to refinance or sell. So delinquent tenants are caused by a couple of different things, but they are the root source of a big risk in multifamily. How can you offset it? A lot of these can be offset by getting a good deal. So if you get in at a good cost basis and it turns out to be well rented, then you can overcome some of these delinquent tenants, even in a bad economy, which you have no control over. Excuse me. But this is, something that is a huge risk, and we're probably going to see more and more of it coming up. As I said, the past few years, we haven't seen it much at all, and it can lull people into a false sense of security that, hey, we can just keep underwriting rents at 95% occupancy and above. Next one, treacherous debt terms. So I was careful not to say here over leverage or floating rate debt, even though those are things that people think of when talking about risks in multifamily. But treacherous debt terms can mean a number of things, but really just getting debt that when things go bad, it's going to make the deal a lot worse. I always say that debts, loans, mortgages, whatever you want to call them, they have they're not good or bad. They just amplify what's already there. So if you have a good deal in your leveraged, it'll make it into a great deal. If you have a bad deal in your leverage, it's going to turn it into a terrible deal. Of course, you can be over leveraged, but I like to use extreme examples. So imagine we get 100% financing, which someone might look at and say, hey, that's really, you're over leveraged. But let's use this extreme example. It's a $10 million deal, but you've somehow got it for $1 million. If you've 100% financed that $1 million, then compared to a $10 million deal, which is its actual worth, you're only 10% leveraged. So it's not just about the percentage of LTV which you're getting, it's compared to how good the deal actually is. Where a lot of operators get into trouble is when they're highly leveraged into bad deals. They've overpaid at the start. And then when things start going wrong, unexpected capex, delinquent tenants, like we talked about, now they start to be in real trouble because they can't pay back the debt. They can't make the monthly debt payments. So that's a huge one. Obviously, floating rate debt people have talked about in the past before. This is where you have an interest rate which is variable based, mostly based on where the 10-year treasury is. In the past few years, they were very low. People got floating rate debt for one reason or another. And as interest rates rose over the past 2-3 years, these people couldn't make their debt payments. Their debt payments started doubling and sometimes tripling, and it just didn't make sense. The rents did not double and triple, so they couldn't make it work. So treacherous debt terms could mean a broad array of things, but it really comes down to how good is the deal that you got and how well you're operating it. A lot of times a good deal with good operations can overcome bad debts, but the reverse isn't necessarily true. So treacherous debt terms, if you stay good leverage, you get a good deal, you're more or less going to offset that risk. Last one we have here is aggressive underwriting. So this isn't necessarily to do with the property itself, unlike unexpected capex or delinquent tenants, but having overly aggressive underwriting is a huge deal. And you've seen a lot of stories out there about super aggressive underwriting. And the truth is they're trying to make not necessarily good deals look good. And if you're an LP out there or you're just curious about how what to look out for when you see aggressive underwriting, there's really two factors when you look at an underwriting model. Number one is rent growth. If someone is projecting rent growth, large rent growth over consecutive years, that should be a huge red flag. We're talking like 5%, 6%, maybe even more. Yeah, it's very likely that If you have a solid area, you could say that, hey, the year one, we're under rented, we can increase rents by 5 to 6%. When we're talking 4 to 5 years down the road, no one knows where rents are going to be. So the further you go away from the mean, and the mean may be around, call it 3% rent growth, depending on your area, plus or minus 1%. But if you're maxing out that rent growth year on year, that's going to be really hard to hit. And if you put regular numbers in place, say a 3% in place, that might actually turn the deal upside down. It's actually not going to be a profitable deal at all. So rent growth is the one thing. What are the operators projecting for rent growth, especially in the later years, 4, 5, 6, 7, if the investment goes that far? Very difficult to predict that far out in advance what actual rent growth is going to be. Year one, year two, okay, you can get away with that, but later years, I would be very suspicious of that. The other thing to look out for is exit cap rate. This can vary the deal a lot. If you have an exit cap rate that is lower, meaning more expensive than the entry cap rate, then that's also a bit of a red flag. It can make the internal rate of return numbers look really good, even just by a quarter or a half a percentage exit cap rate. That's called cap rate compression. So what you should be looking for is either stable cap rate or even ideally cap rate expansion. So if you got a good deal at a 6% cap rate, put the exit as 6.25 or 6.5 even, which if the deal still makes sense with that cap rate expansion, then you got a really good deal on your hands. Now, it's say that cap rates actually turn out to compress over the course of 5 years, then it's going to turn a good deal into a really, really good deal. So the key is to use that cap rate and that exit cap rate. If it does turn out in your favor, then it's gonna make a lot of investors very happy. But you can't count on it. If you're counting on cap rate compression, then the deal could turn very ugly if it doesn't turn out. So that's all we have time for this week. 4 biggest risks in multifamily investing and how to offset them. We'll see you in next week's video.